Alec Walker, Managing Director of Crestmont Private Wealth. In today's episode, we will be talking about emergency funds. If you have any questions about whether you have too much or too little cash on hand, you can contact us via info@crestmontpw.com. So generally, when we earn income, there's three things we're going to do with that money. We're either going to spend it, save it, or invest it. We're all human, so more money that we keep in our spending accounts, the easier it is to swipe that card, meaning there's more money going out the door and less money that's being allocated to our longer term goals. That's why we do think it's important to have an automatic and recurring transfer from your spending account to a separate savings or investment account. Now, why have an emergency fund that is separate from, say, an investment account? There's a couple of reasons. A few of the main ones are, A, we don't want to disturb that investment account. We want those assets to keep compounding toward those long-term goals, and we don't want to have to pull from it in an up or down market. In a down market, that could be pulling out at an inopportune time like this year, or in an up market, that could cause some unforeseen tax consequences that cause our emergency expenses to be even higher. So we want to have a separate savings account that's liquid and that's not going to lose its principal value to market volatility. And this is primarily to manage unforeseen layoffs, maybe reduced income due to a slowing economic environment, or just major home or medical expenses that you didn't plan for in your budget. And again, that emergency bucket is going to be consisted of liquid assets that are going to maintain their value. So yes, they are going to lose out to inflation, which is why it's important to not have too much cash on hand, but an appropriate amount to manage those expenses. So we're talking about checking accounts, savings accounts, money market accounts, things like that that you can access easily. So when we're looking at how much, a good rule of thumb is either 3 or 6 months. So 3 months of fixed or variable living expenses are going to be primarily from married couples where both spouses are gainfully employed, or if there's a single wage earner, but there's a separate second sizable source of income outside of the primary employment. 6 months of expenses is going to be for a single wage earner or for a married couple where only one spouse is gainfully employed. And now these are just good rules of thumb to live by. You can always go a little bit higher, maybe a little bit lower if you think your job is extremely secure. But other folks have, what I call the sleep well at night money. And this could be a nice round number, maybe 25, 50, 100,000, an amount that's in the bank that helps you sleep well and not worry about the market turbulence and volatility. Now, retirees, that amount may be a little bit higher. Maybe it's 12 to 24 months. And even though you're not earning an income, you are taking an income probably from your portfolio or other sources. And so if you do have an unforeseen emergency on more of a fixed budget, it is good to have that money set aside in a separate account. That way you're not having to ask your portfolio for more income when the market is down like it has been this year. Again, if you have any questions about your personal situation, you can contact us via info@crestmontpw.com. Thank you.